Good afternoon, good morning, good evening, depending on where you are. Welcome, everyone. Really delighted to have all of you join us today in what is a very exciting topic and one that's particularly pertinent for us at the moment on the continent as we try and mobilize incremental capital for impact in a time and space when money is scarce. We're facing various headwinds. Aid has been cut, our government struggling, and yet we have an increased need to support our growing population on the continent. So really delighted that you could all join us, and we are grateful to our partners, C3, All for Impact, and our panelists who made time to join us today. So I do want to get us going so we can not only discuss the outcome of the study that was done, but also get into a bit of the Q&A with the panelists and look at what questions you guys have for the panel and for us to respond to. I just want to also make everyone know that you're part of a history-making webinar at AVPA. We've never had this many people register for a webinar before. About 1,000 people have registered for this webinar, so we look forward to a good number of them turning up. Victor, if I go to the next slide. So as part of the work that we're doing to support impact investing on the continent and advancing capital flows. Those of you who know AVPA, we're a Pan-African network of impact investors. One of the things that we're doing extensively at the moment is offering opportunities for people to learn a bit more about the impact investing space and advance your skills, but also plug into communities of practice of your peers so you can learn more beyond the training through sharing ideas and other forms of knowledge. So there's three fellowship programs that we're running in the next couple of months. The first one is our Impact Investing Program, Fellowship Program. That one starts on the 25th of March, which is tomorrow, I believe. Yes, so we're super excited about this one. The next one that's coming up is particularly pertinent to this topic. We've seen a huge need for people wanting to learn more about catalytic capital, and hence the response to this webinar. So we'll have this particular fellowship starting on the 13th of May. You all can register for all these fellowships. There'll be links in the chat to lead you to where you can apply. And then the third one is one around impact measurement and management. This starts on the 3rd of June. Once again, you'll find the details of this fellowship posted in the chat. But to also support all of this stuff, the next slide will speak to a new, really exciting AI-powered data tool that we've developed at AVPA that is able to track capital flows into the continent, looking at where money is coming from, where it's going, into which SDGs, into which country, and most importantly, and relevant to this conversation, we're also able to track catalytic capital flows into the continent. So for those who are willing to learn a bit more about this data tool, we'll be running some demonstration sessions in the next couple of weeks. You can use the QR code at the bottom right, but we'll also give you some dates. Please register for the demo sessions. And I think you'll enjoy what this data tool is able to do to you. The few who've used it are really excited about just the doors it's open for them, the number of new co-investors is unleashed for them, the number of new opportunities, but super exciting. And the good thing about this data tool is we're updating the data every month. So the latest data we have is January 2026. And so we're able to do this, thank God, the AI machinery we have at the back end of this tool. So the next slide will be a quick poll that we just want to check and see which of these might you be interested in. So Victor, do you want to run this poll? And if you do, then what AVPA will do is we'll follow up with you in the next couple of days to give you all the necessary information that you need to be able to engage all these tools. So remember, the first three are training programs. So the Impact Investing Fellowship Program, Catalytic Capital Fellowship Program, which we are very grateful to MacArthur Foundation and C3 and University of Cape Town Barker Center for helping us pull that together. And then the IMM training starting June 3rd. And then the dashboard is a data tool. Those of you who sign up for the demonstration session, you also get a 7-day free trial. So Victor, maybe another 10, 15 seconds on this, and then we can close. And I'd like at this point in time to welcome Umi from our Catalytic Foundation and part of C3, who've been big partners for AVPA for a long time, but most importantly, in the support of the study that we'll be seeing in the course of this presentation. So Umi, over to you.
Thank you, Frank, and wonderful to be here. I'll wait till the poll goes off maybe to get started.
It's off on my side, Umi. Is it still on your screen?
Yeah. It is showing. No, it just went. Okay, perfect. Thank you so much. So a big thank you from the Catalytic Capital Consortium to many, many folks here today, Frank and Victor and Nasri for helping us pull all of this together, to Emily and Catherine for doing the work that we are going to be beginning the conversation today with, and to all the speakers who agreed to share their expertise and experience. I think all of us are united in the effort to think about creative and powerful ways to leverage the resources we have in order to create change towards the SDG goals and the impact that we're all focused on. So the Catalytic Capital Consortium is an investment, learning, and market development initiative that was formed in collaboration with other funders and investors. We at MacArthur originally started this with Omidyar and Rockefeller, and then since then, 10 new funders have joined the collaborative to help us move our work forward. The investment work sits at MacArthur, and we have made about 12 investments across different markets and regions. These are all demonstrations of the power of catalytic capital in different settings and sectors. And that work happens in partnership with other investors and actors who support and work with those enterprises, organizations, and funds. On the grant side, we are housed at the New Venture Fund, and this work supports field building activities so that investors find pathways, tools, and resources to get more acquainted with catalytic capital and to deploy it more effectively on the ground. We define catalytic capital as flexible, patient money that takes on roles that other forms of more commercial money cannot, in order to create more impact and bring other investors and money to the table. Please visit our website to take a look at the different activities we have engaged with, the work that our partners have produced, and the results from all of these different efforts. There is quite a bit of knowledge there, and we are especially grateful to Emily and Catherine for this particular piece of work, which came out of our group of investors that was really looking at the question of how we can be more supportive of catalytic capital deployment on the continent in order to hit some of the goals and impact that Frank mentioned as well. And as part of that work, we requested Emily and Catherine to see if they could take stock of the landscape and what people are really doing to address some of these significant challenges that I think all of us are familiar with. I will not go into the content here, but what we found was that there was a really, really impressive and inspiring array of efforts where different stakeholder groups have come together to create platforms, solutions, tools, all with the goal of addressing some of these challenges. So I would, hand off to Emily to really talk through what's happening. But before that, I just want to take a moment to remind all of us that each of us has a unique role to play in the ecosystem. And we should be thoughtful both about what we do with our own resources and our own mandate and how we can inspire, influence, and support others. This is a very, very young field, and we have many challenges to work on. And the more we can be thoughtful about partnering and collaborating with each other, as well as trying to be focused on the challenges, the specific challenges that need tangible action, I think the more we can take things further than otherwise possible. We will be putting up the results of the work. It's a short piece on the website for C3. The team will share that link after this. Please feel free to engage with all of that. And then the last thing that I'll say is that our aspiration is to put together a virtual community of practice around this particular topic of working with African SMEs in the context of providing catalytic capital and transforming the scale and depth of engagement there. More information is to come. Please write to us at C3. You can reach us through the website and our email. If you're interested in being part of that virtual community, and of course, we'll be putting out word about it with folks that have signed up for this webinar and beyond. When that gets live, that will give us a forum to pull in information on what people are working on in different areas of the space, and hopefully create some pathways for quickly aligning with folks that are doing similar or related things to each of us. So with that, I think I wrap up and we move on to the substance of this conversation, which promises to be very interesting. Thank you.
Thank you, Omi, for your support and guidance throughout this process. And I would like to thank again also the 6 foundations involved in the C3 Africa thematic group, the AVPA team for co-hosting today's presentation, and of course, all our speakers who will bring their perspectives in the next section of the webinar. Good afternoon, everyone. My name is Émilie Deblaine, and I'm the co-founder of All for Impact. It's a pleasure to share with you the key findings of this study on how to unlock more catalytic capital for African SMEs. Our objective in this work was twofold. First, it was to map existing and emerging sources of catalytic capital for African SME intermediaries. And second, to identify practical pathways that will help mobilize and scale that capital more effectively. So beyond the mapping itself, and as Omi shared, the study is dedicated to asset owners, asset managers, intermediaries, and ecosystem builders committed to increasing both the supply and the deployment of catalytic capital for African SMEs. Next slide, please. So why this matters now? Let me start with the why. African SMEs play a major role in job creation, stronger value chains, and inclusive growth across the continent. Yet, SME finance still falls far short of demand, and the gap is widening as international capital and development funding is coming under increasing pressure. At the same time, the ecosystem is far from empty. It's actually vibrant and evolving. The study highlights that 255 SME funds operate across the continent, and that around 80% of them are currently raising capital. These intermediaries are typically small, often in the 10 to 50 million USD range, and sometimes smaller, but they are critical because they provide growing businesses with the right type of capital, combined with technical assistance and strategic support. So the key point is this: the need is urgent, the ecosystem exists, and catalytic capital may have an important role to play in helping that ecosystem grow. Next slide, please. In terms of methodology, this study is grounded both in experience and research. It builds on more than 15 years of experience engaging with investors, donors, both public and private ones, interested in SME finance, but often constrained in their deployment. It was complemented by desk research and literature review, as well as more than 50 strategic interviews conducted between July and December 2025. And it was complemented by an online LinkedIn poll targeting African angel and diaspora investors to have a more granular approach. In total, more than 35 case studies were included in the research, from which 15 initiatives were selected as illustrative examples that contribute to the deployment of catalytic capital and have a potential to scale further through grants, investments, or partnerships. Next slide, please. So this slide summarizes the approach we took in the study. We started by defining the end beneficiaries, which are small and growing businesses, and clarifying their needs, not only in terms of capital, but also in terms of technical assistance and support. From there, we mapped the direct funders that support them, such as SME funds, non-bank financial institutions, and fintechs. The next step was to identify the capital providers behind these intermediaries, both public and private, local and international, from concessional to commercial capital. We then observed major trends for each group and segmented these capital providers by investment patterns, but also by drivers, expectations, and constraints. And finally, we focused on pathways and key initiatives that may help unlock catalytic capital at scale. So the logic of the study was to move step by step to align relevant sources of capital with the actual needs of African SMEs and their intermediaries. Next slide, please. One of the central findings of the study is that different providers matter at different stages of the funding continuum. In the earliest phases, on the left, acceleration, warehousing and structuring, donors and philanthropic actors such as foundations and some family offices often pave the way through grants. At first fund stage, where much of the market sits today, we see the greatest diversity of investors, typically providing small to medium ticket sizes, often with risk-sharing features. This is also where many fund managers face the most difficult fundraising journey, as they need patient catalytic capital to support a first close and build an early track record. Angel and diaspora investors can play an early role, especially when mentorship and small seed investment tickets matter. Corporates may step in there where there is a strategic alignment, mostly via their own investment vehicle. As intermediaries move from a first fund to a second and successive funds, and once governance, track record, and risk-return profiles are stronger, institutional investors can become a significant source of capital. Of course, we see public financing institutions operating across the continuum using a wide range of blended finance tools. So rather than searching for one ideal provider of catalytic capital, the real question is which kind of capital is best suited to which stage and what conditions may help it flow. So now let me turn to the heart of the findings, the 5 main groups of catalytic capital providers we focus on, and why it may take to unlock each of them. As I go through them, I will also mention some of the illustrative initiatives selected in the report for each group. I will keep these examples brief, as several of them will be presented directly by our speakers in the next part of the webinar. So first, family offices and foundations. Here, what we see mostly in Africa is philanthropy in social sectors by foundations and more commercial approaches with selective commitments to impact-oriented initiatives from family offices. These actors are often motivated by values and a long-term commitment to local development. But the barriers remain significant. There is still limited familiarity with catalytic and blended finance tools and difficulties finding strong impact opportunities with track record and measurable results. The pathways that seem most promising here are peer exchange and the provision of co-investment opportunities. The 3 illustrative initiatives highlighted in the report for this group are AVPA, Seventh Generations Africa, and ERFIP. AVPA was presented earlier by Frank, so I won't go back on their work related to catalytic capital, but strongly encourage you to subscribe to one of their fellowships. Seventh Generation Africa is a platform working with African family offices on governance, philanthropy, and co-investment, showing how family wealth can be better structured and connected to impact opportunities on the continent. And ERFIP is a global South network of families and asset owners promoting more strategic and investment-oriented philanthropy, showing how peer learning and thematic platforms can help mobilize private catalytic capital. We will hear more in the next part of the webinar about the role of foundation in this space with Monica from Open Value Foundation. The second group is about African angel and diaspora investors. Our study showed that it was actually one of the most dynamic segments. The study points to rapid growth in angel networks, moving from 10 to 75 over the last decade, while diaspora remittances remain significant, way over ODA, but they are still mostly informal. The strength of this group are proximity to entrepreneurs, willingness to experiment, and a strong desire, especially for diaspora investors, to give back and contribute to the development of the local private sector. At the same time, the barriers are real for these groups to invest in African SMEs. There's still a strong fragmentation of the market and high structuring costs due to the small ticket size they can provide. What seems most needed here are stronger syndicates and platforms and trusted products that can aggregate smaller tickets into productive investments. The three illustrative initiatives highlighted in the report are We Capital, African Angel Academy, and Catalytic Africa. African Angel Academy is a learning and community platform for angel investors, which has trained 800 angels over the last 3 years through 12 cohorts, contributing to build this new category of investors. The second is Catalytic Africa, which is run by EBAN. It's a matching fund mechanism designed to mobilize local and diaspora angel investors in order to reduce risks and encourage collective investment into early-stage African ventures. And We Capital will be presented directly by Astu in the next segment of the webinar. The third group is with large corporations. This group is actually less developed in Africa than in some other markets, but the trend is interesting and important. The study points to the launch of corporate impact funds and strategic skills-based volunteering programs, which are often driven by strategic alignment with core business activities, innovation agendas, and CSR priorities. The barriers here are often internal and relate to governance constraints or misaligned timelines. The most promising pathways to mobilize more catalytic capital for corporates includes anchor commitments into their impact funds and structured volunteering or technical assistance partnership through sector-specific approaches. The three illustrative initiatives retained in the report are a new fund of funds sponsored by BPA France, OCP, Partners in Food Solutions, and Gaia Impact Fund. BPI France and OCP, a large Moroccan group leader in plant nutrition, are launching a fund-of-fund platform focused on agriculture, food security, and climate resilience. It will be announced in Q2 2026, and it's showing how corporates and institutional actors can align around sector-focused investment strategies in Africa. Partners in Food Solutions in a non-profit linking African food businesses with volunteer experts from major global food companies, showing how structured technical assistance can strengthen SME growth and local value chains. And we will hear more about Gaia Impact Fund from Gabrielle at Schneider Electric in the discussion that follows. Fourth group is about African institutional investors, which include sovereign funds, banks, insurance, and pension funds. This is potentially one of the most important long-term sources of domestic capital. But today, allocations to SMEs, private equity, and venture capital remain very limited. The constraints are familiar, among which fiduciary and regulatory constraints, as well as transaction costs. Here, the pathways are relatively clear and are already being experimented via funds of funds, structures, and guarantees of first loss layers. The three examples, illustrative initiatives highlighted in the report are Shigaba, the INP LP community, and Oryx Impact. Oryx Impact is an impact fund of funds anchored by an African sovereign wealth fund and a Gulf TFI, showing how larger scale capital can be mobilized into African SME funds manager through fit-for-purpose structures. The INP LP community is a platform convening limited partners around African PE and VC, sponsored by Iridus and Small Foundation, and Shigaba will be presented in the next part of the webinar by one of its anchor investors, Abraham, from Stanbic. And finally, the fifth group is, of course, related to public financing institutions. These actors already play a central role because supporting African SMEs is closely aligned with their mandates around jobs, inclusion, and resilience. They can deploy grants, technical assistance, guarantees, and concessional capital, and they are increasingly focused on mobilizing private capital as the public resources become scarcer. but there are also constraints: complex administrative and compliance processes, and a limited range of tools which can fit smaller and first-time local funds. So the opportunity here is not simply more capital, but better coordinated capital, more joint learning, stronger local pipelines, and more effective blended solutions. The three illustrative initiatives retained in the report are IYBA, FSD Africa, and ICAMA. IYBA is a Team Europe initiative supporting MSMEs, especially young and women entrepreneurs, showing how public finance platforms can combine finance, skills, and ecosystem support at scale. ICAMA is a GIZ initiative supporting innovative investment vehicles for African startups and growth firms, showing how public and private actors can co-create models to mobilize more capital despite persistent market barriers. And we will hear more about FSD Africa directly from Z in the discussion that follows. So the broad conclusion from this slide is that while these 5 groups differ in their motivations, constraints, and investment patterns, we've seen some common unlocking conditions clearly emerge across them. And this is what I'd like to turn to now. Next slide, please. So when we step back from the different groups and recap what we've heard, observed in the unlocking strategies, we see 3 major enablers coming through very clearly. One is about education and training. Many actors still need practical exposure to catalytic capital tools, peer learning opportunities, and a stronger narrative around what works in African SME finance. The second is tools enabling environment. This includes syndication mechanism, investment platforms, benchmarking of SME funds, and overall stronger market infrastructure. And the third is about access to de-risked investment opportunities. This means not only first loss or matching mechanism, but also a more visible and shared pipeline of catalytic capital opportunities in Africa to facilitate sourcing, due diligence, and co-investment. In other words, unlocking catalytic capital is about reducing friction, improving visibility, and building the conditions that may make deployment easier. This leads us to the final recommendations, and last slide, please. So the first is about addressing the transaction size mismatch that we see between the needs of SME intermediaries and capital providers. This means for larger investors, designing and launching wholesalers or fund-of-fund structures that allow institutional capital to reach smaller funds efficiently. On the other hand, for smaller investors such as angels and diaspora investors, it means pooled vehicles that make participation easier and more efficient in terms of risk management rather than direct deals. The second recommendation is about building thematic coalitions of impact-driven investors around priorities such as climate, gender, or food security. The idea here is to foster alignment between asset owners, create stronger blended finance opportunities, and concentrate resources around shared impact priorities. Third recommendation is, of course, to replicate proven locally rooted mechanisms while adapting them to the realities of each African market. The point is to back intermediaries with strong market knowledge and to scale what is already showing traction. So in a sentence, the opportunity now is to connect, strengthen, and scale what is already emerging. To conclude, this study shows that the ecosystem is already active, that multiple sources of catalytic capital do exist, and that the real challenge now is to make them better understood, better structured, and better connected to concrete market opportunities. And this is what we will hear about now with the speakers. Thank you very much, and I'm happy to open the floor to our speakers and to Catherine, who will be moderating the discussion.
Okay, thank you very much, Émilie. So I'm Catherine Dubreuil-Leroy, co-founder of All for Impact, and I'll be moderating this amazing LP panel. So we've brought together these 5 very different types of capital providers that you saw in the report. because unlocking Catalytic Catalyst is not a solo act, as you know. It requires a coalition and 5 different entry points into the same ecosystem. So let's start. So before we get into the substance, my dear panelists, you will all have 1 minute just to introduce yourself and also the specific initiative that you're bringing to this conversation. And then I'll ask you one question to start. So let's go. So first we have Monica for the group of foundations and family offices. So Monica, so just in 1 minute, who are you and what is the Catalytic Ventures initiative at Open Value Foundation, please?
Okay, thank you. Good morning, everyone. Well, basically, Open Value Foundation is a family foundation which is linked to financial or asset management group in Spain. We have been supporting social enterprises at the early stage since almost 20 years ago, in tickets that goes from 30 to 50K. However, we realized that the companies in Africa and in Spain, and more recently in other emerging markets, and basically something that we realized probably a year ago or a year and a half, it was that this was enough because companies needs the ones that are in the missing middle, they need larger tickets. So that we have created Catalytic Ventures, which is an impact investing club, where we join family offices, foundations, and business angels to mobilize capital, investing in social enterprises in these regions.
And Monica, so what was really the tipping point that made Open Value decide Catalytic Capital was worth the complexity beyond grant making?
Well, basically that we saw that funding, as you started this webinar, is scarce. And we, at the same time, we realize that there are investors that maybe they are able to invest smaller tickets than an institutional investors, but basically they don't know how to start on this impact investing path, where they can find curated pipeline, good opportunities to invest, and so we decided that to put our experience on I don't know, like available for them, and offering this opportunity to join from us on the sense that on a sense that they can learn, but they can also have this access for a curated pipeline. They also have access to a structure or centralized due diligence, so that's good for them and also good for the companies, because we are the intermediaries between the group of investors and the companies. And basically, because it's given the experience that we had previously, we have this experience structuring deals. So the idea for this kind of, or the goal for this kind of investors is what they are able to mobilize capital, starting from small, basically.
Very insightful. Thank you, Monica. And now Astu, so you're here for the Angel and Diaspora Investor Group. So in 1 minute, who are you and what is WIC Capital doing today, please?
Thank you very much, Catherine, and thank you for the invitation to be on this webinar. So I am Astudia. I am the president of the Women Investment Club Senegal and also a board member of WIC Capital. So WIC is, I would say, a triptych, 3 different mechanisms that are here to support entrepreneurs and mostly women entrepreneurs. When I say 3 mechanisms, because the first one, which is the association, is pulling and mobilizing capital from retail investors, so women like myself that have decided that they wanted to support other women entrepreneurs. This money is then put into a fund, which is WIC Capital, and the money that the women are putting together is used as leverage to also go and get more capital from DFIs and other investors that are interested in supporting women entrepreneurs.
Thank you, Astu. And so WIC turned Diaspora Energy in a structured fund. And what is actually the biggest friction that still prevents more angels from making that same leap?
Well, the biggest friction is actually regulation, because what we see is that in Senegal, for instance, we have capped the number of women that can actually be part of the club to 99, because the OWADA regulation, if you go beyond that, you become a financial institution with all the requirements that come with it. And that has been one of the main hurdles and that we've been working on. We have gone around it by you opening other clubs in other countries. So we have a week that is also in Cote d'Ivoire in discussions with countries like Togo and Rwanda to have more women joining the movement. But that has been, I would say, one of the constraints that is preventing us from opening it to the many other women that are ready actually to support women entrepreneurs.
Thank you, Estu. So now we're moving to Gabrielle for the corporates. So Gabrielle, so in 1 minute, so maybe on Schneider Electric's commitment to Gaia Impact Fund, we could maybe have insights from your side, please.
Yes, thank you, Catherine, and hi, everybody. And yeah, really happy to be here and share a little bit of the experience of Schneider Electric. So I am in charge of our impact investing activities in Europe and Africa. We are present through different vehicles. In Africa, we have investments through our fund, Schneider Electric Energy Access, which we manage ourselves, started in 2010. And as Catherine said, through the Gaia Fund, started in 2023, in which we were an anchor investor. And the fund is targeting, in a nutshell, low carbon energy transition. Why are we there? This is originally because of impact. We actually started impact investing in France as a way to respond to a legal obligation for French companies. And then we built around that, creating other vehicles and eventually investing in Gaia in order to create impact around our sustainability strategy, which includes an element around access to energy. And so part of the impact and the beneficiaries that are generated in the investments that are made by the Gaia Fund are then reported in our own corporate indicators and targets.
Thank you, Gabriel. And so Schneider came in as a 100% private capital anchor, no DFI. And so what made that possible internally, and what would stop another corporate from doing the same, actually, from your side point of view?
Yeah. Internally, I'd say, unfortunately, I don't have the silver bullet. But I think what characterizes us as a corporate investor is that we're obviously in it for impact, as I said, and it is linked to our sustainability strategy. So even though I would not consider ourselves as a fully strategic investor, we have our CVC and we do other things in that respect, but we are there for impact. And as I said, it's directly linked to our corporate sustainability strategy. But we also get other benefits from this. As I said, we're not fully strategic, but this enables us to have an indirect presence on some markets where, as a business, we are not as present directly. It also opens us, and when I say us, I also mean our leaders, to development institutions, investor networks, in which we have actually over the years, because as I said, we started this in 2010, so we've been in it for a long time. We've got some fairly good acknowledgement of our presence and our role in impact investing and development, and that is also seen as a value of what we do beyond, obviously, the impact and the support to the SMEs.
Thank you, Gabriel. So now we're moving to Abraham for the African Institutional Investor Groups. So maybe Abraham, so in 1 minute, maybe we can have more insights on Stanbic's LP position in SIGABA and what the fund does, please.
So thank you very much, and good morning, afternoon, evening to everybody on the call. So Stanbic Investment Management Services is a Ghana-based asset manager, one of the biggest pension fund managers in the country. And we have been very interested in moving pension capital, which is purely commercial, from over-reliance on government and lending to government or giving to government to the alternate markets. And so we wrote our first check to the alternate market in 2010. And we have been very interested in ensuring that when catalytic capital is available, pension and commercial capital is able to come to play to actually actualize the dream and the objective of that catalytic player. And so when it comes to Chigaba, we saw the innovation of the first private fund of fund in Ghana and West Africa. And we saw the impact that the fund, when supported, is able to come to market with. And so when the fund manager and the team came to Stanbic, we found it attractive, willing, and able to put pension capital to where real economy actually works.
Thank you, everyone. So the figure we got is that African institutional investors manage roughly $4 trillion, and just less than 1% reaches SMEs. Terrible. So Stanbic crossed that line. So what's the one barrier that keeps most of your peers on the sidelines, you think?
Education, knowledge, and fear. Many a times, the commercial capital players are unwilling to try anything new beyond what is already in the market, being the traditional tool that they know, no matter how bad in Ghana, for example, the government became, people still stuck with them. But one of the things that we have learned as Stanbic is to open ourselves to institutional investors like FSD Africa, like IFC, so that we can, IFC, I meant, so that we can learn from the best, learn their tools, and come to market ready and able to implement and learn from what they have done. So that is one of the things that I have seen stops mainly commercial capital from coming to the table.
Thank you, Abraham. And last but not least, Z, so for the public finance institution groups, so maybe you can give insights on FSD Africa, and in particular, the Nyala's facility, and what you're most proud of so far, please, Z.
Hi, everyone. Z, Head of Investments for early stage and venture at FSDAI. FSDAI is the investment arm of FSD Africa. We are funded by the UK government. Our mandate is to make finance work across Africa. And how we do this is we combine the market building work of FSD Africa. So they're providing technical assistance, ecosystem support, concessionary capital, alongside catalytic investment capital that's deployed by FSDAI, really to test, accelerate, and scale new financial intermediaries. And specifically from an early stage finance perspective, we focused on alternative local capital providers, these emerging managers. We see them as critical in really addressing the financing gap in the small growing business space. We have two facilities in the space. We've got our Nyala facility, which is focused on female fund managers, first-time female fund managers. And then we've got our climate facility that really looks at climate smart managers who've very much focused on adaptation and resilience. And yeah, we've invested 50 million to date across about 18 intermediaries. I think really proud that we often, along with other catalytic investors, are the first institutional investors in these managers. We work in partnership with them to help prove and refine their models and really try and support them in the transition to become commercially investable. So trying to scale them to the point where the likes of the DFIs and local institutional capital can come in. And really proud of our work and proud of the intermediaries that we work with.
Thank you. Amazing. And from your side, so FSDI Africa goes where commercial capital won't. So what's the hardest thing to change, you think, from the inside? So the instruments, the processes, or the narrative around risk?
I think so the narrative around risk is an important narrative to address. There's, and I think it really comes through in your report as well. We need better coordination, more data, etc. But mostly what we need at these early stages is more capital to come in, so more catalytic capital, There are a number of intermediaries playing in this space, but we need more capital to really try and scale these managers. So I think for me, that is the most critical gap at this stage.
Thank you, Zee. So now we're moving towards round 2 of questions. So just so what I'm hearing across all 5 of you is a version of the same paradox. So we hear a strong motivation from all of you, real constraints, maybe legal, and a gap that sits somewhere between instrument design and trust also. So now let's talk about what actually closes that gap. So same principle you have. So there's one question per person. This time we're going to be even more concrete. So not what should happen in theory, but what would make you personally deploy more capital faster or being peers along with you. So maybe one thing, a tool, a structure, a partnership, a regulatory change. What moves the needle most for you? So we're starting again with Monica, the same order. So Monica, you think, is it about better pipeline access or about having a co-investor you trust enough to follow? Or maybe can you give us a concrete deal or structure where Catalytic Capital genuinely changed what was possible for the fund manager? So maybe you're doing this.
Well, basically, I think that the first thing when we talk about catalytic capital, we need to think that not only in concessionary financing, it means that it's not just like talking about low returns or lower returns compared with other instruments. It's basically that we are unlocking other flows of capital for the future. So something that I could say is in general, in the case of the club that I'm leading, is basically that we join to these other co-investors that have the same appetite that we have, we share values, and we have the interest on this kind of companies. So I will say that the first point for this is trust, basically, because they trust on us not only in the pipeline that we are finding and that we are analyzing, but also they are trusting in our analysis, and they are trusting that we are going to maintain this relationship with the company, especially because we are talking with I think this is very important because we are talking with Spanish and European investors who maybe are not close or are not related to African realities or, well, in other emerging economies. So I think that trust is one of that, and is the element that is, I don't know, in the middle of this club. Also, I will say that in our case, we're trying to analyze the companies on the sense that it's a kind of capital that is not easy for the companies to leverage, and there is some uncertainty and risk, like in any other investment. But we're trying to show that the result that this company might have in the future with the deployment of this capital is related to innovated to build the history for the company or to as I said before, to leverage more funds. So I think that more than the promise of for the group that we have, more than the promise of the financial return, or maybe more than the risk that there is a part of that, part of the thing that they feel that they are building for something else in the future that is going to maintain in the future is something that is also part of the motivation that the group of investors has in order to participate with us.
Thank you, Monica. Very interesting. And now heading to Astu, so for the diaspora and angel investors. Do you think is it a bottleneck? Is the bottleneck a product design problem or a distribution problem? So maybe the insights on your side.
I think that for us there are two sides of the bottleneck. There is one bottleneck which is around how do we mobilize more capital from angel investor, diaspora, and the women that are already shown appetite to actually support entrepreneurs. And the second one is how do we design fit for purpose vehicles. And in our I would say experience with WIC, the first one in terms of bottleneck, as I mentioned earlier, is really around regulation. We have more than 100 people that are on the waiting list to join the week. And every time we do an event, they want to join and then want to put their money towards investing into women. But because of this regulation that we have, we are very cautious in how we onboard new investors. So what we do want to change, and also I know that there are organizations like the African Crowdfunding Association that are pushing for more regulation around crowdfunding that will allow for those retail investors to come into the investing space. So for us, this is one, I would say, solution that would make it easier for the WIC model and movement to be deployed more largely across the continent, and starting with Senegal already. We've been able to mobilize 1.5 million euros with the women in Senegal. We could be able to mobilize 10 times that between Senegal and the other countries that we've been talking to. So that's the first one. On the in the investing side, I would say that the constraint or the things that we are looking at is how do we reduce the cost of investing and the cost of doing the due diligence, identifying the pipeline. And especially when you see that the needs of SMEs are not necessarily, I would say, huge tickets. How do we design instruments that allow us to serve between the 50,000 and the 300,000 K? We've had to move. That was our first thesis for our first fund, and we've done it with a lot of sweat and a lot of support, also from an organization like Nayala and FSD. For the second fund, we've moved upper in the value chain because of the transaction cost, and because for us to be viable, we need to increase our ticket sizes. But that doesn't mean that the need from the entrepreneurs is not there. And so for us, the thing we're thinking of, and the thing that we want to move forward with WIC, is how do we have other instruments, whether they are debt or grants or however we want to structure them, to allow us to serve that population that is still needy.
Thank you, Estu. Regulation is a point. I see Elizabeth is connected in the webinar, and it's a main topic. So I think it's a big issue. Thank you, Elizabeth, for the work you've been doing. Now heading to Gabrielle. So Gabrielle, would Schneider consider anchoring a second fund if the structure addressed the timeline misalignment you were talking about?
Yes, I hope so. I mean, so as I said, this is all connected to a broader mission of Schneider Electric, of bringing energy for sustainable development, and we want to do this for everyone. That includes also regions where, that access to energy is not as available as it could be in France typically. So, and where market conditions do not enable us to go there directly as a business. So we want to go there indirectly through impact investing as a means to do it, but we do also have other ways. We have an access to energy business as well. So at least what we want to do is to be able to be successful enough in our investments to be able to recycle that capital. Because as I said, as a corporate investor, we consider ourselves both catalytic in the sense that we do not necessarily need, as Monica said, to have a strong return on investment. What we want is really to generate sustained, transparent, and hopefully massive impact. And so we would necessarily recycle our capital, but we also are in the process of raising other funds. And in order for us to be able to do so, we need other investors. And that may be also a specificity of Schneider Electric, because when we invest, it's not only either when we set up our own fund or we invest in other funds. Obviously, we do it with other LPs. And that's also because we want to be catalytic. And we are seeing at the moment, we're facing more difficulties than we have in the past in raising capital from, let's say, the traditional investors. So, and that won't be a surprise, but blended finance can also be an accelerator, because as I said, we're catalytic in the sense that we're more patient, we're less focused on return, but we're not yet, at least, offering first loss or these kinds of investment. And they are very welcome in our different initiatives to support, greater fundraising from any type of investors and obviously other corporates as well.
The additional question, maybe, Gabriel. So who you think should provide this additional funding in the ecosystem?
Well, I mean, we see a lot of foundations and similar organizations starting to go into for-profit with those typical offers. And I think this is very welcome and can be truly catalytic. I think also I would encourage other corporates to join, and not necessarily, as I said, with first loss or anything like that, but maybe more corporate. I mean, we are, I guess we're quite proud that Schneider has been in there for so long. And unfortunately, there are still very few corporates. And if there are any other corporates around the table or listening to this, I would like to say that, as I've said, it goes beyond investing and beyond impact. We see true benefits in terms of strategic presence and things like that. But it is also a good way to generate important impact at an actually quite low cost in terms of expense, because it's an actual investment for us. Obviously, there's a risk on the capital, but it's an investment. And at times where companies are also, looking at their costs and conditions are maybe a little difficult, this is also a great way to keep generating important impact.
Thank you, Gabriel. So I hope your corporates here listening to you will join the coalition and step in your feet, your example. Very interesting. Now we're heading back to Abraham. So fund of funds, guarantees, first loss tranches. I mean, the study flags all three, of course. So which one actually moves pension funds in your experience? So funds of funds, guarantees, first loss tranches.
From my interaction or our interaction as Stanbic with the market, the presence of other proven commercial players like DFIs that have done it in the past is one of the key things that our trustees or those who ultimately make the decision look out for. Also, the presence of catalytic capital is very important. Many a times we underestimate the effects it does, but one of the things that we have seen is that whenever there is catalytic capital to essentially de-risk the asset, then even though we are purely commercial and investors are purely commercially driven, they are more likely to come to the table looking at the presence of catalytic capital to say that, okay, we can also minimize our commercial appetite because there is some catalytic capital on the table taking substantial risk or opening the door for us, the commercial investors, to come into the room. So the presence of a credible DFI or investor is important that we can learn from. The presence of catalytic capital is very important in any form. Junior, first loss in any form helps. And the final one is the ability of the asset to be a bit unique, not the normal, while driving impact. Even though we are commercial, one of the things that the trustees are always interested in is what is going to be the legacy beyond the financial return for our economy, what's going to be the legacy for our market, what's going to be the legacy for the asset that we are going to back. So one of the things that anybody coming to the market, especially looking for commercial capital to come in, is that beyond all the catalytic, it must be unique. It must leave some legacy for the players so that the pension fund managers can look back, or the pension players can look back and say, we were the people who built the hospital that's operating 40 years after we initially did the investment.
And maybe just, Abraham, what would you say right now to other African asset managers watching from the sidelines, if you had something to tell them?
The market is ready. There is assets, there are good assets. If anybody watching wants to come into the market, I always say that it's always good to get people that have done it before and learn from when there are questions to be answered. But more importantly, the view should not be just the financial return that we'll get in the next 1 year, 2 years, 3 years, maybe 5 years, looking at a government bond, but looking at the impact that the asset that we are going to back is going to live. So, for example, in one of my meetings, I tell my trustees, if we built a modern hospital in Ghana with our capital, which may not return the capital immediately in the next 5 years, but it's going to return capital in the next 10 years, 15 years. But then in your old age, you are going to collapse, and I ask you, our traditional hospital versus the modern hospital we built, which one do you want me to take you to when it collapses? The answer is always unanimous, and everybody chooses the modern, because then it gives comfort that beyond the financial return we are getting, we are able to, in the country, improve, for example, health, we are able to improve education, and that is some of the things that I'll say anybody on this call, especially asset managers, to be able to sell to trustees to go beyond just the financial return. Thank you.
Thank you, very insightful. And now Z, so Nyala is scaling from 15 million to 50 million. What needs to be true for the next investor to come in without you having to de-risk it first?
Yeah, I think we need better coordination across the catalytic capital providers. And I really like the slide you put up, and that's part of your report, that actually maps all the types of capital that it's available. And sort of really an understanding of how we align support across the life cycle of these managers. And then I think what's also important is blended tools, smart subsidies, examples of returnable grants for OPEX that can actually help these managers become sustainable at smaller fund sizes, so that they can start deploying capital, they can build a track record and really refine their investment thesis so that they can, attract the more commercial capital. We're actually working on a facility at the moment called the Manager Finance Facility, which is designed to use concessionary capital returnable grant exactly to do that. So providing OPEX funding, piloting capital, but really linked to the catalytic capital that's available in the market to really help these emerging managers strengthen their businesses and improve their sustainability, etc. So yeah, I really think it's not a problem of pipeline. It's more of a coordination problem, and we really need to look at the space with that systemic lens and build a system that can really produce investable managers.
And now, interestingly, we're going to have a cross-panelist moment because there's interaction in this ecosystem. And so as he mentioned, so with Nyala facility, this facility has directly backed weak capital. So I'm heading back to Astu. So what did that investment unlock concretely? And what would you still have needed you didn't get? And maybe Z then can jump in back after Astu's insights.
So Z will come into the next fund and the following one, so it's perfect. No, what it has definitely unlocked is, as I mentioned, we did our first fund, and it's a 5 million euro fund, and Nyala came with a 1 million euro debt instrument that allowed us to actually complement our investment into the 10 companies we've invested in between Senegal and Cote d'Ivoire. What it has unlocked is really us to be able to have that demonstration effect that we want to have, that investing in women entrepreneurs in our localities is something that is not only makes sense on an impact, I would say with an impact lens, but also makes sense in an economic and employment and return lens. So we're very much very grateful for having that Nyala facility come to the fund one. And what we really look forward is, with that demonstration effect, and it's already happening with the second fund, is really I think it's Monica who was mentioning trust. It builds trust into the following investors, and now we're seeing that we're able to mobilize even more capital from other DFIs and moving forward. I would say if we come up with another instrument in the next 2 to 3 years, I think that we've done, but we will have built not only that demonstration, but also that trust from actors in the ecosystem, and it will just make it easier for us to fundraise and to deploy that following capital.
So maybe Z, if you want to add something with this concrete example with
Yeah,
Wick
I
Capital.
think it's been really interesting for Wick. I think the capital that came from Nyala actually really helped them sort of refine their investment thesis and really set them up for Fund 2. There's been a lot of learning. The Fund 1 was an open-ended fund. Fund 2 is a closed-end fund. So really positioning them well for the DFIs. Also, there's been an evolution in the size of the ticket, the type of capital they deploy. So yeah, I think it's been an excellent learning journey, and they're well positioned for their Fund 2 and Fund 3. I wish we could support your Fund 2 and Fund 3 as a two, but we really play that early role. But yeah, it's been a great relationship and partnership with WIC.
Thank you. So and now I'm just going to wrap up very quickly so that we can leave some time for question and answers, because I think most of you here are here for also to have a direct chat with everybody. So we saw 5 different investor types, 5 different constraints, and even more. But the solutions from what we hear keep converging around the same 3 things: aggregation of vehicles to solve ticket size mismatch, and we heard also, especially in Senegal with WIC, de-risking instruments to give someone a confidence to go first, who goes first, and shared pipelines, so due diligence doesn't get done 5 times over. And yeah, so now let's hand over to Emily for the question and answer session. And thank you so much for dear panelists for all these different questions. You did not even have them before the panel, I must say. So you did a great and amazing job. Thank you for sharing all these amazing insights.
Yeah, thanks very much for all your insights. Very interesting for the conversation. So we have a few questions, and if you have more, please use the Q&A box in the screen. So we have one for Gabrielle. As a private company, are you looking for financial performance where investing, or is it rather pure CSR approach? And which amount of annual investment are we actually talking about?
Yeah, thank you. Thank you for this. So as a company, as I said, it's important to have in mind that everywhere we invest, either in the funds that we've created and manage ourselves, we invest together with other LPs, and they can be DFIs, it can be other private investors. So that also conditions the performance of these funds, or at least the expectations. Now, as a company, if I say what is expected of me, being in charge of these investments from my CSO, I think it would be closer to capital conservation than generating an actual return. Or if I say it differently, the highest expectation is on impact and on the value it can bring to the company beyond the financial return. Because anyway, our cost of capital at Schneider Electric is pretty high, so we know this is not where we will match or exceed it. It's really around what we get from it from an impact perspective first, but also, as I said, from all the co-benefits that we get, the strategic presence, the network opportunities, and also the employee engagement that it generates, because that's something I didn't mention, but we also create some mentoring opportunities, and we are also trying to develop a lot more technical assistance to leverage the 160,000 employees of Schneider Electric all around the world and be able to support those startups and SMEs in which we invest. And that is a great lever for employee engagement, and that's highly valued by the company management.
Thank you, Gabrielle. We have one question from Esther regarding the difference between grant funding and catalytic funding. Maybe I can ask Monica if she's willing to take that question.
Yeah, of course. Well, basically, in the case of catalytic capital, we are talking about financial return. So it's different than grant making, basically, because you are able to recycle money and use it again for other investments. And also, I will say that it's one that is that in one part, and as I said in my previous intervention, is regarding to build track record or innovate or something that is going to help the company to reach to set the basis to reach more funds in the future according to its growing plans. So that's, I will say that was the difference.
Thank you. We have one question from David to all panelists, asking how the organizations assess investment risk and then therefore cost of capital when deploying capital, especially differences between Africa-based and non-Africa-based investors. Who is willing to take this question? Cost of risk, cost of capital.
Sorry, we just Abraham and I are together, and we dropped off for a second. Can you repeat the question, Emily?
The question is from David and asking how do your organizations assess investment risk and then therefore cost of capital when deploying capital? Do you have a different risk assessment if you're Africa-based or non-Africa-based?
Well, I think it depends on if you investing in local currency or in hard currency. I think that has such a big impact on kind of your risk assessment and the risk premium that's applied. Our funding, our investment capital is hard currency, so we sort of are able to take some local currency risk in some of our transactions and then try and diversify it away. For instance, Chigaba, we one of the Catalytic investors in that, and it's a CD denominated fund, and so we carrying the FX risk, and we hoping to sort of use diversification even from a Chigaba perspective, where 50% of the funds are going to be investing in Ghana and 50% across the region. So we're hoping to get some protection from that. But I think that is a huge driver of the risk premium.
Thank you. We have one question from Samki. Much of the conversation focuses on de-risking through structure like first loss and guarantees, but for supply chain finance managers, the bottleneck is a mismatch between a strong track record and institutional minimum ticket size. So also this goes back to the question we had with Abraham. What mechanism do your organization use to bridge that gap for emerging managers who can demonstrate quality before scale? So maybe Abraham, can you also share more about your experience and dealing with these large institutional investments that needs to go into smaller funds?
So thank you. I hope you can hear me. My experience is that when it comes to the presence of de-risking, as I said, that is one of the most important variables that I have seen open the market. It helps to be able to mobilize large-scale commercial capital. But one of the things that always is present in the room is, if this is new and this is that novel, who is in the room with us? No commercial capital wants to be, or from my experience, no one wants to be in that room or on that table alone without the presence of other people that they can look at and say, okay, I am learning, that is learning, but this person has done it before. And so it helps to moderate essentially the risk and the appetite. To remember that, as I said, it is fear, it is knowledge, and it is education that is stopping many people. And so when there are other investors in the room to explain the risk, to explain how the mitigation has happened, to explain how that cost or that capital is being compared to what Treasury bills is giving or what government security is giving, then it helps to reduce and moderate the room into seeing the bigger picture beyond just what the T-bill rate is on the market at the moment. So the knowledge is important, but what I've learned and I've seen is that the ability of commercial capital to come does not reside just in the presence of the catalytic capital, but in the presence of who else is normally in the room, bringing expertise, bringing knowledge to the table. Thank you.
Thanks you, Abraham. So we are almost out of time. I know that Frank has one final question, but maybe before I'm handing over to Frank, do you have any last words, call to action for each of our speakers, and then we can wrap up the session? What would be your call for action, Monica? Call to action.
Well, I will say that is to try through education and peer learning and any other way, trying to change this, to learn from catalytic investors, I would say, and to change this mindset, that because sometimes I feel that everyone is agree on provide catalytic capital, but in practice, when we want like transformation, but at the same time we are seeking for stability, and we don't have. It's not possible to have both things in the same transaction or platform or whatever. So I think it's needed that if you are looking for any organization wants to start to do a catalytic investment needs to change their risk appetite, right? So that will be like that, to trying to learn to follow that path.
Thank you, Monica. Astu, one final word, call to action.
Yeah, I think that the call to action is everybody should enter into catalytic funding. And to respond also to one of the questions that is in the chat, which is what is the difference between grant funding and catalytic funding? I think it's catalytic funding is you're patient. As Monica say, you're willing to take more risk, but it doesn't mean that you're necessarily forgetting about the money that you're putting into these businesses. So really thinking catalytic funding as something that is supporting the SMEs in a longer term, but that is still looking for return, but taking into account the context and the difficulties that are pertaining to our local context.
Thank you, Astu. Gabrielle?
Yes, can you hear me?
Yes.
Yes, I would say, yeah, for us, it's really about, well, keeping doing what we do and keeping being, as Astu just said, a catalytic investor, in the sense that we are patient. We are also trying to attract those other investors by providing our experience and our expertise, and sometimes also our commercial and business opportunities in order to help those SMEs and de-risk those early stage business models in which we invest. And we hope that can generate new initiatives and investments among other corporates. So, yeah.
Thank you. Then Abraham?
Okay, so I would say that beyond the catalytic capital that is available, I will request and I will ask the ecosystem developers and those with history to devote some capital to educating the local pension trustees and the local pension players, because knowledge helps reduce the risk, because perceived risk can be higher than the actual risk. And when there is education, when there is knowledge to the trustees, part of the capital should go towards providing hard data knowledge to the trustees to reduce the perceived risk and then make them comfortable to try and take on new assets. But beyond that, I will also say that the assets must be unique, must offer something that is different. And we, unlike Gabriel, commercial, we are not as patient. We can be patient, but usually we are not as patient. But when knowledge comes and there's catalytic capital on the table, it helps to open the doors and make money available to these assets. Thank you.
Great, thanks. And final word to Zee.
Yeah, the challenges are huge. The funding gap is huge. We really need to coordinate efforts and partner. So yeah, find partners, work together, and let's try and solve this all together.
Great. I'm sorry, we're running out of time. I won't be able to answer the questions, but actually the conversation is only starting. We have also added our contact details, and we'll be happy to continue the conversation with all of you. I know that the link to the report is also added in the chat box, so you can have a the full report available as of now, and hopefully we can keep the conversation going and have new collaboration opportunities together in the future. I will hand over to Frank for this closing remark, and thank you all.
Thank you, Emily. Thank you, Catherine. To all our speakers, we're very grateful for your time and contribution to this subject and topic of conversation, one that I think has probably the most pivotal impact in what could be, as we think to redefine what sustainable financing of Africa looks like. And I'm a big believer that the world of impact isn't short of money, we're short of risk or catalytic capital. And so this conversation is super, super important. I always tell my team that catalytic capital is like the bride of the wedding. Without it, we're not going to move the capital we need at the required speed and scale to meet our social investment needs, not just the SDGs up to 2030, but beyond that. So very important that we work together on this one. And I think Africa, more than any other region, needs catalytic investment more. So it's so important that we as Africans take the lead in actually pulling these mechanisms together, testing different instruments, scaling proven ones. And I think catalytic capital plays a really critical role in both the seeding of various types of investments and the scaling of proven ones. And what we at AVPA will try and do, and Abram was very clear in saying that we need a lot more education. I think the report also mentioned the fact that there's more knowledge required because we need to build a critical mass of impact players who understand this space and the various approaches. I mentioned to you we're running a couple of fellowships. Once again, thanks to C3 and MacArthur for funding and that's fellowship. So for those of you who are interested in learning a bit more about catalytic investing, please join the fellowship. I think the slide, the link will go up and it will be followed later. But yes, do join this fellowship. And the good thing about these fellowships, it doesn't end with the program. It continues with you moving into a community of practice of former alumni and other of your peers who are interested in this space. So the learning continues beyond the training program. And this is one that we're super, super excited about. So please do make time to have a look at the program, reach out to us through LinkedIn and other mechanisms if you do want to get a bit more information. And then don't forget, we've also got the Impact Investing Fellowship Program, the IMM Fellowship. This is starting the next couple of days. The Impact Investing Fellowship starts in about a month and a half, 2 months. And then for those of you who also just want in the meantime to look at data and what's happening in the data space, this AI tool is amazing. We're tracking about $6 trillion that's coming to the African impact space since January 2023. We update the data every month. We'll be having 3 demo sessions on April 8th, 15th, and 22nd. There is a link for those of you who want to join us, or just once again, connect with us on LinkedIn to express your interest, and we'll connect you to the relevant demo session. But I wanted to say thank you, everyone, for those who've made it. This is the beginning of this conversation. We want to continue having contact with all of you, so please do stay in touch. We shall be having quite a number of things in this catalytic capital space in the next couple of months. You should be you should be able to get connected to your peers. We'll be creating communities of practice where people can come together to do more as a collective, learn as a group, but most importantly, see how they can leverage catalytic capital to crowd in more private capital into spaces and sectors that they care about, which are currently struggling because it just isn't enough money to flow into some of these social investments. So the big challenge we have right now is how do we do more with less? And catalytic capital is a big enabler of that possibility where we can amplify impact and deliver multiply effects many times over what we have in terms of resources. So I want to say thank you, everyone. Once again, to our partners, C3, Umi, thank you so much. Emily, Catherine, All for Impact, thank you so much for your time. To all the speakers, we're super, super grateful for you dedicating time to be here. And once again, please stay in touch. Stay in touch. Let's follow up on some of the things we've discussed today, and we'll continue this conversation. Thank you so much.